Hey there, hello, and thanks for joining me. This is a pencast I'm making for Accounting 1120, and it's on the topic of plant assets. I have a couple of goals I'd like to take care of in this pencast, and one is define plant assets, talk about them a little bit, and then the second goal is to look at some ways that we do accounting for acquisition costs. So, let's get started. Let's work a little bit with the definition of plant assets. First of all, plant assets are things that we purchase for use in our business. We don't purchase them because we want to resell them at a higher price. We purchase them because of their use value to us. Secondly, they're usually quite long-lived. They will not be consumed in one accounting period. There often will be several accounting periods that they'll be consumed over. Because of this, we have to depreciate them. And depreciating a long-lived asset is simply writing it off over the periods benefited. So, when we get a plant asset, say we have one and it's going to last for 5 years, let's say our plant asset costs $5,000. It's what we paid for it. We're going to write it off evenly over the periods benefited, and then it won't be worth anything at the end. We would depreciate the plant asset over 5 years, and that would equate to writing it off over the income it produced. Each year, we would make an entry to recognize $1,000 in depreciation expense. And the entry would look like this. If you recall from previous accounting classes, depreciation expense and accumulated depreciation, in our case, would be $1,000. So depreciation expense would be $1,000 each year, matching the cost against the revenue it generated. Accumulated depreciation, the contra account where we record the depreciation expense into, would be $1,000 the first year, $2,000 the second year, $3,000 the third year, $4,000 the fourth year, and finally it would hold the entire amount of the asset. As you'll recall from previous accounting classes, accumulated depreciation is a contra account. On the balance sheet, we would show our equipment, and it would always be shown at what it cost us. And then we would show accumulated depreciation depending on where we are. Let's say we're in year 3, we've written off 3 years worth. It would be subtracted off, and the asset would be shown at its book value, which would be $2,000. We usually don't write the word book value on financial statements, but it is a concept. And it is how much we have left to write off. In this case, our equipment costs $5,000. We have written off $3,000 so far, and we have $2,000 left to write off. Accumulated depreciation is a contra account, and it's contra to the equipment account. And this is how we recognize we're using it up. So, definitions are a plant asset is one that we buy for its use. It's long-lived. We depreciate it. We show it on the balance sheet at cost less accumulated depreciation. I think that pretty much handles how I wanted to do the definition of the plant asset. Let's move now directly into acquisition costs. When dealing with acquisition costs of plant assets, it's important to realize from the beginning that we're going to capitalize into the equipment account everything it costs to get an asset in place for its intended use. Hold on, the phone's ringing. Wow, long phone call. I'm not sure where we are. Anyway, acquisition costs require that you capitalize everything it costs to get an asset in place for its intended use. The word capitalize means that you go to the balance sheet account. So let's say we're buying a piece of equipment, and the piece of equipment costs $10,000. So we would capitalize the cost of the equipment by putting it in the equipment account. If we had it shipped to us, and shipping costs $250, we can't have the equipment if we don't have it shipped to us. So we'd also capitalize that and put it in the equipment account. Then let's say maybe we have to make a cement mounting of $1,000. You can't have the equipment if you don't have it mounted, so that would get capitalized. All of that goes into the equipment account. And perhaps you need to have an electrician come in and wire it. Let's say that costs $500. That would get capitalized. All of that getting capitalized into the equipment account. Then let's say further, some idiot dropped it and broke it, and that costs $250. That wouldn't get capitalized into the equipment account, because that's not a necessary cost of getting it ready for its intended use. That's the cost of hiring wrong person. Humor. Anyway, so what becomes the cost of this equipment in our case is $10,250, $11,250. How about $11,750? And that would become the cost of our equipment that we will have to depreciate in the future over the periods it benefited. So familiarize yourself with that term, capitalize. That means to stick it on the balance sheet. To capitalize means to put on the balance sheet and then write it off over the periods benefited in the future. Compare that to the term expense. Sometimes we have costs like when we have to pay to get something fixed because an idiot dropped it, and we'd expense that immediately, and that means we put it on the income statement as an expense in the period immediately because it wasn't a necessary cost of getting something ready for its intended use. So the idea of capitalize versus expense means, are we going to the balance sheet and writing it off in the future, or going to the income statement and writing it off immediately? Interesting terms heard very often in an accounting office. Let's continue. Sometimes when we do a purchase of an asset or an acquisition of an asset, we get involved in many costs. Let's say we purchase some land that has an old building on it. So here's our piece of land, and it has an old building on it, and we pay $50,000 for the land and the old building, and we promptly knock down the building. That's called raising the building. Interesting term, knocking it down is raising it. And the cost to raise the building or knock it down is $1,000. That becomes part of the cost of the land. And then let's say we have a machine come in and grate the land and make it ready to use, and the machine's grating cost is $10,000. So that gets capitalized into the land. Then let's say that we start to build a building on the land. We excavate it, we dig a hole, dig the basement and the foundation. That then switches over and becomes part of the cost of the building. Notice the old building didn't. We knocked it down, so it didn't become part of the cost of the building. But digging that hole in the foundation for $10,000 would become part of the cost of the building, because as soon as we start down that street, we start with the building. Then we pay a construction company put up a building for us, and the building's, let's say, $500,000. That would get capitalized as the building. Then we need to landscape, because we want our building to look nice, so we put in a parking lot. Well, landscaping, I guess we're going with trees. There's a tree on our building, or on our land, and we need to put a sprinkling system in so it will water it. We landscape it with trees. that doesn't become part of the cost of the land. That becomes part of cost of building improvements. We must separate them because the sprinkling system wears out. But the land itself doesn't. So we landscape with some trees and some other things, and that costs $3,000. And then we put in that sprinkling system, and that costs $5,000. You know, they're not cheap. Then we got to build a big light, because we want our parking lot to have light on it. Lighting doesn't become part of the cost of the land. It wears out, and lighting our parking lot becomes $2,000. Look at all these costs we have. And this all started with the purchase of land and an old building. How much should get put in the cost of the land? How much should get put into building? And how much should get put into land improvements? By the time we had suffered all of these costs, our land would be $61,000. The cost of our building would be $510,000. And the cost of our improvements would be $10,000. We would capitalize these costs onto the balance sheet. We would have land, which doesn't get depreciated, at $61,000. We would have the building, which does get depreciated, at $510,000. We would have land improvements, which do get depreciated, at $10,000. They would get depreciated at separate amounts. All of these would be shown in long-term assets under plant assets, or maybe another term, property, plant, and equipment, on our balance sheet. In this case, we would pick up all of them into those categories. This example just talks a little bit about how a purchase of land and old building and construction costs might get capitalized onto the balance sheet. Let's look at another case. In this example, let's say you do a lump sum purchase where you buy a building that's already up and functional, sitting on some land with some improvements that have already been made. And you get this appraised, and the appraisal shows that the land is worth its fair market value from the appraisal, $500,000, the building a mill, and the improvements $250,000 for a total of $1,750. Because you're a very clever bargainer, you're able to purchase this. You're able to purchase this at a price, $1,500 or $1,500,000, yeah, $1,500,000. Woohoo, go you! How would you record this purchase? How can you make this set of facts work for this circumstance? Let's think about it. You have some land, you have a building. You must separate the two because one depreciates and one doesn't. And you have some improvements, and you're going to make your journal entry reflect all of this. And then, of course, you're going to credit cash or mortgage payable, whatever it is you did to pay for this. Let's say you paid cash. How are we going to split the cost of the land, building, and improvements and make it fit our $1,500,000 purchase price? We can't put the fair market value of the items in there. That equals $1,750,000. We can't record a gain. We haven't sold anything at a gain. So we must make this set of information fit into this journal entry. What would you do? Well, we'll take the lump sum purchase approach. Well, we'll say, let's figure out how much land is of the total purchase price and building of the total purchase price and improvements by dividing the cost of the land over the total price, the cost of the building, and leaving zeros off, over the total purchase price, and the cost of the improvements over the total purchase price. So when it all adds up, we'll have all of it allocated. Let's turn those into percents and put them right here. Put me on hold and figure out what percent the land, the building, and the improvements are using the mathematical equation that I've written right here. Let's see what you come up with. When I do the math the first time, it comes up to 28, 57, and 14. It's 1% off, so I took it out another decimal, and I came up with the fact that the first one was 29.5%, or 28.5%, so I'll use 29% for the land, 57% for the building, and 14% for the cost of the total purchase price, and that will equal 100% if you add them up. And I did do a little rounding. I rounded to land. So 29% of 1 million would equal what? 57% of 1,500,000 would equal what? 14% of 1,500,000 would equal what? And all of these equal 100%, so it should equal the cost of our land. Put me on pause, and using the lump sum purchase method, figure out what you think this journal entry should show. How'd you do? I took 29% of 1,500,000 and came up with an even 435,000. Pretty remarkable, since I didn't figure that out first, that it's even. 57% came up to 855, and 14% came up to 1,500,000. So the total, 435, 855, and the 210 equal 1,500,000, and that equals our purchase price. The lump sum purchase method uses the fair market value of a purchase, where you've made a purchase of several things at once, figures out what percent of the total fair market value belongs to each category, and simply applies that to the amount of the cash paid to come up with the journal entry that capitalizes all of the costs into the appropriate account. Nice, huh? Well, we're at the end of the time I allot for Pencast to be. And in this Pencast, we have reviewed the definition of planned assets, which is something that we purchase for their use value. They're long-lived, and we need to depreciate them. And then we looked at ways of splitting an acquisition cost to different accounts to properly record purchase by journal entry correctly. We have looked at the idea of capitalizing all costs associated with something to get it ready for its intended use. We've looked at the idea of spending a lot of money on several things at once, like building a building on some land we've purchased and making improvements. And then we finished up by looking at lump sum purchase methods, also sometimes called a basket purchase. And hopefully these ideas help you understand how we acquire and account for acquisitions of property. I can't write as fast as I can talk. Acquisitions of property, plant, and equipment, also known as plant assets. Thanks for joining me. Have a great day. Bye for now.